Reading from the Reference Guide to Regulatory Compliance, Advisories on Predatory and Subprime Lending. The growth of subprime lending products during the late 1990s prompted federal banking regulatory agencies to caution lending institutions about the risks involved in these activities. Subprime borrowers are those with weakened credit histories or reduced repayment capacity. Loans to these borrowers historically have had a higher delinquency rate. Many lenders have expanded their lending programs and added subprime products as a method of meeting their Community Reinvestment Act responsibilities by providing greater credit access to lower-income customers. Regulators raised some safety and soundness concerns, especially where institutions had subprime lending programs with credit exposure greater than 25% of their capital. While most depository institutions lend in a fair manner to subprime borrowers, some lenders take advantage of them by engaging in predatory lending practices. The banking agencies issued 2 guidances to caution depository institutions about risks involved in funding non-depository lenders that engage in predatory lending. Predatory and abusive practices include high-pressure sales, fraudulent marketing tactics, excessive fees and interest rates, including fees for unnecessary products, prepayment penalties designed to trap borrowers in the loan, balloon payments that may cause foreclosures, and lastly, frequent refinancing with fees included in the new loan. Non-traditional mortgage products began to proliferate during the early 2000s as a response to the robust housing market. In 2005 and 2006, the market began to soften. Responding to concerns that this softening market would begin to affect the quality of loan portfolios around the country, the banking agencies issued a guidance in 2006 on non-traditional mortgage products. This issuance covered mortgage loans that have non-traditional features such as interest-only payments or payment option loans that allow the borrower to exchange a lower payment during an initial period for a higher payment during a later period, which causes the loan to negatively amortize. In 2007, with the near collapse of the subprime mortgage market, the agencies responded to a growing foreclosure rate with an interagency statement on subprime mortgage lending to address underwriting and consumer protection concerns. Subsection 1 is what was learned from the interagency guidance on subprime lending of March of 1999. It covered all regulatory financial institutions. It covered subprime loans and loans to lenders or dealers that make subprime loans, and it covered credit extended to borrowers who exhibit characteristics indicating a significantly higher risk of default than traditional bank lending customers. Risk management for subprime lending included planning and strategy, risk management for subprime lending also included staff expertise and lending policy statements, purchase evaluation, and loan administration procedures, as well as loan review and monitoring, consumer protection, securitization and sale, and reevaluation. So these are the basic tenets that were required under the interagency guidance for risk management in subprime lending. Planning and strategy, the first tenet of risk management for subprime lending, is with regards to all proposed activities being consistent with the bank's overall business strategy and risk tolerances. Risk assessment must include operating compliance and legal risks, and planning and strategy must present clear objectives for performance. The second tenet under risk management for subprime lending is staff expertise, and put simply, staff must possess sufficient expertise to manage the risks in subprime lending. The third tenet of risk management for subprime lending was a lending policy that is A, appropriate to the size and complexity of the operation, B, states clear goals, C addresses the types of products offered and those not authorized. D state portfolio targets and limits. E provide lending and investment authority and those not authorized. Addresses the types and products offered and those not authorized. And D states portfolio targets and limits. E provides lending and investment authority for individual officers. F provides a framework for pricing decisions and profitability analysis. G provides for collateral evaluation and appraisal standards. H have well-defined underwriting criteria. I list procedures for tracking and monitoring loans. And J require credit file documentation. Last but not least is the correspondent broker-dealer approval process. The fourth tenet of risk management in subprime lending is purchase evaluation. If the bank purchases subprime loans from other lenders or dealers, it must consider the cost of servicing those assets and the loan losses that might occur. Due diligence must be performed before purchase. The fifth tenet of risk management in subprime lending is the loan administration procedures. The bank must monitor the performance of subprime loans. Collection procedures should be in writing. The bank should document the methodology for allowance for loan lease and loss evaluations. The loan review and monitoring. Banks must perform ongoing loan review and subprime loans in the portfolio, and all credit scoring pricing and ALLL adequacy models should be reviewed. The seventh tenet of risk management in subprime lending is consumer protection. Banks must take care to avoid violating consumer protection laws in subprime lending, including loan discrimination and illegal steering. Securitization and sale. The eighth tenet of risk management in subprime lending involves management, referring to FAS 125 for accounting for these transactions, and banks should also consider appropriate discount rates, credit loss rates, and prepayment rates when evaluating these assets. Lastly, reevaluate. Banks should periodically evaluate whether the program has met its objectives and performance goals. The guidelines for national banks to guard against predatory and abusive lending practices, released in 2003, was released with the purpose to provide examples to national banks of practices that may be abusive, advise banks on how they should avoid abusive practices, and show how some abusive lending can involve unfair or deceptive practices and therefore violate the Federal Trade Commission Act. The guidelines defined abusive lending by a variety of lending practices, and with the fundamental characteristic that aggressive marketing of credit to prospective borrowers that cannot repay it on the terms provided. And typically such loans are underwritten on the liquidation value of the collateral rather than the creditworthiness of the borrower. Further, the guidelines outline practices that accompany the marketing of predatory or abusive loans. The presence of one factor alone does not necessarily indicate a predatory or abusive practice, but these practices include loan flipping, which are frequent refinancings that do not benefit the borrower. This practice can result in borrower injury from the fees imposed and from the fact that it decreases home equity and increases the consumer's debt burden, thus increasing the chance of foreclosure. 2, refinancing of subsidized mortgages that result in the loss of terms beneficial to the borrower. 3, packing of excessive and hidden fees in the amount financed. 4, using loan terms to make it more difficult for borrowers to reduce or repay the debt. 5, using balloon payments to conceal the true burden of the financing and to force borrowers into costly refinancing and foreclosures. 6, practice was targeting inappropriate or expensive credit products to older or unsophisticated borrowers who would qualify for mainstream credit products. 7, the 7th practice of providing inadequate disclosures of risk and costs of the credit. 8, offering single premium credit life insurance. And 9, use of mandatory arbitration clauses. D, the guidelines explains what refusing to purchase the following types of loans, the guidelines explain to banks that refusing to purchase the following types of loans can reduce the possibility of purchasing abusive mortgage loans, and those loans including 1, loans in which the lender has not adequately determined the borrower's ability to repay the debt; 2, loans subject to HOEPA; 3, loans with points and fees in excess of 5% of the loan amount; and 4, loans in which a prepaid single premium credit insurance policy was included in the amount financed. The Federal Trade Commission Act violations were outlined in the guidelines. 1, the OCC considers that a practice may be deceptive and therefore unlawful if each of the following factors are present. That's A, a representation, omission, act, or practice that is likely to mislead; B, the act or practice would be likely to mislead a reasonable consumer, that is, a consumer targeted by the act or practice; C, the representation, omission, act, or practice is likely to mislead the consumer in a material way; and 2, the OCC will consider that a practice may be unfair and therefore unlawful if each of the following factors are present. That's the practice causes substantial injury to the consumer. Injury caused by the practice is not outweighed by competition. The injury caused by the practice is one that the consumer could not reasonably avoid. And examples of such unfair practices are loan flipping and equity stripping. Loan flipping may be unfair because it increases the chances of foreclosure by decreasing home equity and increasing debt burden. B, equity stripping is the practice of making loans secured by the consumer's home but with high upfront fees that are financed and secured by the home. Violations of other laws outlined in the guidelines was predatory lending practices such as frequent refinancing can also violate HOEPA, and 2, steering borrowers to loans with higher costs can involve illegal discrimination under fair lending laws. Further, under the Community Reinvestment Act, predatory lending practices can adversely affect the bank's CRA rating. And avoid predatory and abusive lending practices. It can be done by establishing policies and procedures and also establishing loan quality credit control reviews, I should say. The policies and procedures adopted should address sound credit underwriting policy and should also address the circumstances under which the bank would make loans that have features associated with abusive lending practices, and adopt policies concerning the appropriateness of transactions involving unsophisticated borrowers and the use of loan proceeds, the borrower's understanding of how the loan meets his or her needs, and the bank's assessment of how the loan will meet the borrower's needs. Within establishing loan quality control reviews, documentation reviews should be periodically performed on a random sample of the loan portfolio, and any necessary corrective action should be taken, including addressing borrower injuries. The next section on page 22 is avoiding predatory and abusive lending practices in brokered or purchased loans. This was released in 2003.